We're proud to have this episode sponsored by Shakepay, the easiest way for Canadians to buy and earn Bitcoin. I love using Shakepay because it's fast, it's easy, the app is great, and it doesn't hurt that they give away free sats, which is free Bitcoin, every day just for shaking your phone. They also have the Shakepay prepaid Visa card issued by People's Trust that earns you up to 2% cash back in Bitcoin. Not points you have to redeem, just Bitcoin added to your account automatically. Like I said, Shakepay really is the easiest way for Canadians to buy and earn Bitcoin. So join the over 1 million Canadians already on Shakepay. Sign up is fast and free. It's so easy, a boomer can do it. Plus, sign up for Shakepay with the promo code Loonie Hour, and you'll receive $10 after you buy your first $100 worth of Bitcoin. That's promo code Loonie Hour. Thank you, Shakepay. Now back to the show. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to Loonie Hour, episode 68. As always, joined by the three amigos. We got Rich Diaz of Acorn Macro Consulting, and we got Keith Dicker of IceCap Asset Management in his San Fran 49ers jersey. Congrats on the win, Boomer.
We've been winning for a long time now. I think they've won 12 straight. Anyway, I like football. It's my thing. It's like 9-dimensional chess compared to everything else. And we got another one this weekend. Could be the second last game. Well, it is the second last game of the year.
What's the prediction?
So this jersey I bought this back in the 1930s, I think, when they first discovered gold out west. I got this in the early 80s. And so I've been out for a few games out on the West Coast, and 3 different times people try to buy it. They try to buy it from me. They're like, wow, where do you get that?
That's cool.
Oh, yeah. Like, you just can't get, this thing, like the long arms, the sleeves and stuff. But
who was the quarterback back then?
It is Joe Montana. Okay. He was pretty good. He played okay for a while. What's going on, Rich?
So
what do you got going on overseas?
Nothing. It's a rainy, crappy day in London. Just hiding out here.
The Love Loft.
No, sadly, I've been kicked off the island. So back to square one. All alone with a broken heart. At least I have you guys, and at least I have my charts. My charts keep me happy.
We'll get you going at the Calgary Stampede this summer.
That's right. But no, I'm ready to go, boys. Let's kick it off.
Keith, when you watch those 49ers games, you and Mrs. IceCap, those are like late, aren't you? Like you're over in Halifax, so like the time zone. I'm surprised you're able to stay up for those games.
No, the NFL it's a machine. The games. They start.
What time do they start?
1 p.m. 1 p.m. Eastern and 4 Eastern. So if you're a West Coast team, you're playing at 4 Eastern, which is 5 o'clock here.
If you get like the Sunday nighter or something.
Yeah, those can be tough. You need a nap in the afternoon on those days.
There it is.
Yeah, it's true. Yeah, but Mrs. IceCap, she has a Frank Gore jersey and all that. So and Junior has a jersey, and same with the wee one. We're all into it. It's fun.
It sounds like a ride. I might become a 49ers fan just so I can get invited to the IceCap.
Going to a like NFL football game, the full experience, like you go tailgating and everything, it's a good like 7-8 hour day, to do it right.
What do? You show up with your fancy bottle of Pinot Noir at the tailgate?
He's not the only one. It's Northern California. Of course, there's going to be loads of people with Pinot Noir and charcuterie.
The craziest place I've ever been to for a game for fun was in Buffalo a few years ago. Like it was just outstanding. Those guys, as the guy I was with, I said, wow, like these guys are, they're having a lot of fun. To which he looked at me and he said, Keith, this is the only thing all these people have going for them. That's it. 8 nights a year, they get to have fun, and then it's,
and then they lose in the playoffs. They get kicked, their asses kicked by Joe Burrow, which was a great game.
It happens. So, Steve, what do you got here today?
Yeah, let's jump into it. We had
maybe the Bank of Canada just, they just made a big move. No one saw, maybe.
Yeah, the first in the G7 out of the gates, coming out with a big pause. So it was 25 basis points, which was largely expected, not only from all the economists, but it's funny. I did a little Twitter poll a week out before, and it was like, I think we had almost 5,000 people voted, and 70%. So as Rich says, the audience is the market's usually right. So the market was calling for 25. We got the 25, and we got looks like a pause from Tiff Macklem with the Bank of Canada. So I'll kind of just read a quick summary. Keith, you and I will jump into it because I know we watched the whole presser there. But, he says, quote, in his presser, he goes, with today's modest increase, we expect to pause rate hikes while we assess the impacts. To be clear, this is a conditional pause. It's conditional on economic developments evolving broadly in line with our outlook. And of course, his outlook is what he's referring to in his monetary policy report, which we'll dive into. But Rich, you lost the Twinkie bet this week. What do you got for us?
I'm very sad. So Twinkies are banned in the UK because of some dye that they put in it. So I found something full of more chemicals and more disgusting than a Twinkie, believe it or not. And it's a gluten-free.
I thought you were going to say a lemon loaf.
A gluten-free coconut macaroon. Now, if anyone out there knows me, they know that I absolutely hate coconut. And the only thing I hate worse than coconut is anything gluten-free, because I think that's a bunch of BS. So there you go. It's called Mrs. Crumbles, gloriously gluten-free. And I can assure
the package.
You, there it is. I
don't know. Those look pretty good. I don't know.
No, gluten-free is just such.
She looks like an English lady I dated in the 50s.
I also hate coconut. Hhate coconut. I'm
gonna send you like a lifetime box of.
All right, so here you go. Yeah, I screwed up. I guess I owe it to our fans and you guys that I don't know. I thought I should have known that Tiff Macklem was not going to surprise anybody twice in one 12-month period. There were some really good questions, which I hope you guys get into while I scarf this disgusting Mrs. Crumble.
Speaking of lemon loaves,
gross.
I actually have one because I just love these things, and I was concerned Rich wouldn't have anything there to eat. So,
you're like, I'll do it for you. I'll take one for the team there.
I mean, look at this.
That looks nice though.
The best part of those lemon loaves.
Smell lemon. You actually smell the lemon. No, that comes off the white ribbon.
You take that off?
Yeah. Even
you don't eat it?
No.
Oh man, that's.
You don't eat the
I don't have a sweet tooth. No.
This is disappointing. But yeah, I mean, so it's getting back to this.
Those not following on the video channel. I just took the white ribbon off, and now it's a proper lemon loaf. Okay, let's get into the Bank of Canada stuff. What they said and didn't say.
Yeah, we've got the monetary policy report. So, I mean, you guys can go and download it. I mean, it's 20 pages. It's basically just the update their sort of projections and how they forecasting inflation and whatnot. So, they've got they're basically, to kind of summarize it, they're basically forecasting like a soft landing. So they're calling for a slight reduction in housing activity, a soft landing in the economy. And that's basically, even under that assumption, assuming that they do hit this miracle, they have I think they have inflation getting down to 3% by this summer. And then I think to 2.6, I believe it was 2.6% by the end of this year, and then back down to their official 2% target in 2024. So a lot of, hopes, ifs, and buts. I mean, the reality is they had their inflation call horrendously wrong over the last 18 months. So it's really hard to put too much stock into this, but, so it's a complicated world. But Keith, I don't know if you have any thoughts on, on the monetary policy report and some of the projections, really. I mean, we'll get into the housing as well, because I think that's important. There's a lot of developments that are happening right now. We chatted a little bit of the last couple of weeks, but we'll get into that as well.
So I think, I don't trust the Bank of Canada. I find they're not, it's not a lack of trust because I think they're trying to screw people over. I just don't trust them, and I find they're very inconsistent with what they're doing and what they're communicating. Excuse me. So a couple of things with it. First of all, they did say they're pausing now, or they're going to be on hold until they'll follow data coming through. Usually, and this is like 99% of the time, central banks, once they pause, they pause. The next move is down. And usually, it takes 8 to 15 months or so before the next move happens. So, people shouldn't expect the Bank of Canada is going to start cutting rates suddenly now this summer or something like that. I don't think that will happen. But these guys, the Bank of Canada, I can actually see them raise rates again. If they don't get the desired outcome that they're hoping that they're going to have, then they can do that. And I wouldn't be surprised at all. The other thing is, in our view, the economy hasn't behaved yet in the way they would want it to bring inflation down here in Canada. So with inflation rolling over, I think it's mostly just a mathematical,
reality.
Thank you, Rich. I think that's what's really happening. And with them pausing rates, I am convinced that, I think at the Toronto event, I said, I think the Bank of Canada is a bit spooked. Remember back then, I said they'll do 0. And I think they did like 100 or something, but they did a lot more than 0. It was 50 they did. But I think underneath the system that they are having concerns that, something might fall off. And I think they're actually frightened to death that we do go into anything other than a soft landing. Because they, if anyone listened to the presser yesterday, they took a victory lap. They were running around, so yeah, we did it, high-fiving and, chest bumping is the way, economists do it, an awkward chest bump. Do you do that, Rich? Maybe that's what you should do on a date. When you do a, hey.
I think they would call the cops on me. It's not the 50s, Keith. You can't just walk up to girls and do whatever you want. You have to respect them and be polite and ask for consent, I think, is the new thing.
Okay. So with the Bank of Canada, though, I think something has been moving here in the wrong direction. And I think they're now concerned about it, and they're waiting to see, hey, with these rate hikes, because they went 4.25. They basically went from 0 to 4.5, basically.
Yeah, 0.25 to 4.5.
Yeah,
less than 12 months.
Yeah, absolutely. And now they're saying, okay, let's see what happens here. But their base case is that it is a soft landing. And everyone else out there is saying, yeah, it's going to be a soft landing. You've achieved it. The Americans are sort of talking about the same thing. I'm skeptical. I think it's going to be very difficult for this, this mythical soft landing to arrive. And usually, you jump out of the window and that nice big, big pillow thing they have that the firefighters, that as soon as you're about to hit it, they yank it out or something. So if we do get this thump coming up, I think it could bring all of us back to reality. Because I think right now with financial markets, especially so far in January, everything, it's been risk on again. Yeah. And we'll see what happens, but it's based on, again, the hope that, a soft landing is achieved, China comes back online and all that stuff. But let's make no mistake about it. The Bank of Canada move yesterday, that was a bit of a shocker because, again, they set the precedent that they should continue to raise rates, and then out of the blue, they just said, no, we're stopping. So that you should be concerned about that.
You think it was a shocker though? Like, I mean, I feel like it was pretty well telegraphed that it was going to be 25 and a pause.
And maybe just in that, and the markets had it priced in that as well.
Yeah,
they had 25 priced in. Yeah, but in terms of, but that's my point though. The Bank of Canada, like they're unpredictable, and if you base your outlook based on what they're talking about and what they're looking for, they haven't achieved that yet. So their pause right now, it's based on what might happen in the economy, whether it's 3, 6, or 9 months from now. So we'll keep talking about it and keep watching. I think we're going to get something hitting hard.
They did revise. So they revised, you look at their monetary policy report, they revised GDP forecasts slightly higher, and then they revised their inflation lower. So kind of the best of both outcomes, really, which is obviously your soft landing. But that ultimately brings your prime rate to 6.7% now. So most Canadian banks are at that prime of 6.7, which pretty much puts your variable rate mortgage now, usually prime minus whatever. So, even if you're prime minus half, prime minus 0.75 today is typically what you're seeing. So puts most of your variable rate mortgages, if you're getting one today, would be about 6% now, which means you're stress tested at 8%. So there's still more pain there. And if you're a variable mortgage rate holder, the extra 25 basis points would impact those on floating rates, trigger rates. I mean, I feel like so many people now at this point, anyone that had a fixed payment variable has been triggered and has seen their payments increase. So that will, they'll still feel them. I think the big thing here is like, I'm struggling to see. So like the housing market, there's a large portion of it that's obviously on variable floating rates. You got all this like household debt. So people like assuming that rates even just pause and they stay at these levels for let's say the next, 12 months, that still seems to me it's going to be very painful for a lot of people. And we're hearing like anecdotally, seeing a few more foreclosures. You're hearing the lawyers are getting busy. They're ramping up their files. So to me, there still seems like there's that pain that's coming. There's that sort of default cycle. But anecdotally, what we're seeing in the housing market is it's active. It's busy. Vancouver's busy. Toronto, we're getting reports, our good buddy, listener of the show, we're actually going to have him on the pod here very soon. Ron Butler, who's reporting mortgage volumes are busier. If you follow the CEO of Redfin was out, put like a Twitter thread out a couple of days ago reporting that all of Redfin's sort of analytics, I mean, they've got insane amount of analytics, right? They're one of the largest websites for searching MLS listings in the public, and saying that, they're reporting increase in showing requests and all this other stuff. And yeah, just chatting with realtors myself, even in the US. So it's really interesting because like, you're like, well, rates are still really high. The Fed might still push rates higher. What's going on? Is this just like the bear market rally? Is this the suckers rally? Is this the beginning of, us bottoming and moving on? Keith, I don't know if you have any thoughts on this. Rich, like I'd love to.
Well,
it's the same sentiment in the equities market. Like,
yeah, well, I mean, I definitely have some views on the equity and risk assets, but I think I'll just put a pin in that for a second, and maybe we can circle around. But just one more thing on the Bank of Canada. Keith said, it's basically a hopeful pause, I think is a fair with, some, issues, and that they're looking will improve and to go their way, basically to sort of validate their outlook. But one thing we saw today was the wage growth numbers out of Canada that actually went up again. So we've talked a lot about how the U.S. wage growth is extremely at a 20-year high, depending if you're low income or high income, or even if you're an hourly worker or a salary worker, especially if you're very young, you've got incredible wage growth. Canada, you haven't had anywhere near the wage growth, but it did ratchet higher to, I think, 4.2. I usually smooth my series, but nearly 4% nominal wage growth. And you have really strong employment. So, yes, you're getting some relief, from the Bank of Canada's perspective, you're getting some relief on the price on CPI, and you're seeing core CPI peak and in some cases come down. Their expectations that we'll get to 3 by the end of this year. We'll see. But I think on the other, that there is sort of a dual mandate. It's not clear. It's not as explicit as it is in the Fed, but they're a dual mandate bank, a central bank. And the other mandate is, wages, the labor market. And you have unemployment, which is at like, I think maybe an all-time low or series low or approaching it. You have wage growth that's rising. You have employment. Say what you want about those series, but 100,000 jobs a year. Who knows if it's right or wrong? The point is it's going in that right direction. So it's interesting that they took that victory lap when you have, a bunch of things lining up on sort of the other side of their mandate that would suggest that further rate hikes are actually necessary, despite all the whining in the housing market.
Heath?
Yeah. Again, I'm not convinced, because now, this week we were starting to get earnings reported by a lot of the big companies in the US. And, and the actual earnings number, most of them are in line with expectation, but it's the warnings afterwards. Some have warned lower, others, they always usually you provide a range of what your revenue will be and your earnings will be. And everything is coming off a little bit softer here. And again, so that's bottom up. That's what we're looking at. A lot of the stuff that we talk about is top down, looking at aggregate this, aggregate that. Again, it just seems to suggest to me that the economy, it hasn't rolled over yet. I mean, we'll get the Q4 US GDP numbers, which came out, which is backward looking, of course, right? We all know that. But I don't, especially for the Americans, I don't think the central banks had yet achieved what they want to. So this sudden rebound, we'll see. I mean, you want it to sort of to stay like this. I mean, the best case scenario would be to have 6 quarters of minus a half to plus a half growth, for that long, and then things sort of get sorted out that way. Again, I'm a bit skeptical about where we are with this cycle.
Well, that's what's interesting about, I was going to say, just more further to that point, is as you've seen the rates get higher and higher, you've seen financial conditions actually improve. So there's different ways that you can measure financial conditions. There's, like an equity risk premium. You can look at literally CDS spreads. You can look at literally something called the financial conditions index, which is produced by either Goldman Sachs or the Federal Reserve. You can look at the 10-year bond yield, which is now, I was at 4.3%. Well, just maybe, I can't remember, 4 or 5 months ago, and is now the 3.48. I can't remember exactly what the number it is today, but so different ways. So it's funny how even though you've had higher and higher rates, actually the conditions have actually, for financial conditions, are actually much lower. Another thing that's come down is credit spreads in Europe a lot. We get that European corporate bonds are not as liquid as the US, or maybe not liquid at all, but they've eased in the US as well. High yield corporate bonds, CCC, and those spreads over 5 or 10-year bonds have come in. And so across the board, you're seeing an ease of financial conditions, which would be interesting to see how that's interpreted by the Fed in a couple of weeks.
And that's my point, though. We go from 0 to 5% within a year, for rates for the Americans, and the equivalent for the Europeans and everyone else. And to think you can do that, and it's such a short time frame, and nothing has really happened,
right?
Except for the mathematical effect on the way a lot of the data is calculated on the prices side. So that's why I'm a bit skeptical that maybe something will, maybe the Eagles would score 10 points. That's. But
Are you not surprised? Are you not surprised though? This massive. I mean, the fastest rate hiking cycle. I don't know what, 50 years.
Well, in Canada since 1995.
I mean, there's various ways that people have measured it to say, well, adjusted for debt, this is the tightest, the largest hiking cycle, whatever you want to call it. But I mean, basically, you've moved rates at an aggressive pace in less than 12 months on top of global debt to GDP at 365%. And nothing's really happened. I mean, there's been a bit of a sell-off, there's been a few foreclosures, whatever. Are you surprised? I mean, I'm surprised personally and maybe we're just waiting for this crescendo and something to go, but it's, I don't know what in your opinion, what goes at this point? It's been surprising. We had that big move in the yen at one point, and the dollar was surging, and things looked like they were going to break, and then they've kind of eased back off. It's just, it's really, you're just waiting and waiting and waiting, and so far
what
it's
happened?
all clear.
So what, from an economic perspective and market perspective, it's already happening. So companies are either doing layoffs. I was chatting with someone yesterday, the day before, and we talked about income security, how secure is your income, for your home, and any layoffs yet at your business, and the business where they were working, they said, well, they just had a round last week, and they said, hey, I survived. They survived that cut. So companies have already starting to do that. I think, Rich, you shared with us recently that operating margins for a lot of companies, it's at historical highs. So you can't get any
coming
higher.
Off.
Yeah,
they're rolling over
all
already.
That's coming off. And one thing it's so different and people will laugh when they hear this, but it's so true. Companies run a P&L, it's a profit and loss. We want to maximize profits at all time, and if there's a probability that losses are coming, you tighten things up, quite remarkably. On the government side of the ledger, there's I don't know what they do, but of course, the Liberals were in Hamilton this week having a bit of fun with numbers and some economic fantasy land type narratives. But it's always, spend, borrow on those guys. But the corporate sector is starting to tighten things up. And as they continue to tighten things up, it means that there's less aggregate income into the economy, and which of course, it creates the potential for something to come off here. So that's why I continue to be a bit concerned. It's not really
Can I just jump in there?
We're structured. No, I'm not finished. No, but we'll go in because some people were asking us on Twitter. The RBC CEO, he did an interview with BNN just a few days ago. So we'll talk about that as well. Like, all that is tied together. And I know how to listen to a CEO interview on mainstream media. And maybe we should get him on here, right? We'll see how it really turns out. But
let's go, Dave. Get on here.
Yeah,
there's your invite.
There you go. But that's sort of where we're headed in our mind. It's too perfect. Like it's now starting to crack a little bit, and it doesn't have to have a big fissure, right down the middle, like a lightning strike line. But
do you still think that comes from Europe?
Oh yeah, definitely. Or Japan. It can be. The point is, everything is now, I like to say, risk has been synchronized around the world. I know a lot of foreign managers, and like a lot of them increasingly now, they're calling me, say, what's happening in Canada? This looks like the ultimate, place to make money. And it's on the short side, by the way. They're not looking to go long Canada. And I say, well, that's interesting, because as Canadians, we're looking at other places which might be the ultimate, the place to make money on the short side. And that's it, right? Everything is in this moment where, has reality been suspended? Now, I think it's been suspended for about 12 years around the world. I really do, with zero rates and negative rates and QE. By the way, one thing the Bank of Canada didn't stop doing yesterday was their QT, so the quantitative tightening. So they'll continue with that. So that is another form of, tightening. Monetary tightening. So if they announced they were going to, stop that as well, it would have been a pretty big shock.
Rich, do you know what the percentage of holdings the Bank of Canada has of government debt? I mean, at one point it reached 43%?
Yeah, it's lower now. I think it's
was it probably 30s. In the 30s?
It's in the high 30s. I can't. If you give me a second, I can look it up. But it's in the high 30s. I was just going to say, to add to Keith's point, which I think is just, there's a little bit of patience that I think is required. If you look at all the academic literature around yield curve inversion, which is something we talked about several months ago, it's always 8 to 12 months or 15 months down the line. The similar thing with all the rate hikes, like setting aside the yield conversion, it's after your rate hike cycle, it takes a while for that stuff to feed through the economy. And I think that's a really important, it's I guess we're sort of guilty of it, right? We're always trying to think of the next topic. And in a sense, maybe we're being a little bit impatient, but I think it's important to recognize that it really genuinely does take, 6, 12, 15 months for these things to sort of feed through. And in some cases, I don't think they'll feed through at all. I mean, we've talked about household mortgages in the US, that people picked up at 3%. That's not going to necessarily feed through. And so that I think is really, really important. And the other thing I would also say is there are some indicators that are clearly negative. I mean, if you look at the Chicago PMIs we talked about a little while ago, there's a national activity index that came down. If you look at the ISM PMI for services, that collapsed last month. We're going to get, I think the next one is going to be either next week or the week after. That'll be, I think that's a very, very important data point. That'll, that's 80% or 75% of the US economy is services. There are other, and then also I think was really important is that there's a push pull, and the push is the positivities coming out of China, which is reopening. You can clearly see that it's going on in the equity market. The Asia ex Japan is now as overbought as it's been in 2 years, with the relative strength index above 70. And we're getting basically not shit data from Europe. So ZEW came out, the sentiment index, Authentics. It's virtually every single European data point over the last last month or so has actually gone up. And so that might actually delay any of what normally, if it's that, this is where I don't necessarily agree with the risk being synchronized, because you have now an desynchronized economic indicators in Europe and China and versus the US. But anyway, that's just wanted to add to that.
So what you're right about is that if we do not get a recession now this year, it means the system and everything that we've been using is broken. That's because all indicators strongly suggest we should be having recession, whether it's the yield curve and things like that.
Yeah.
And the fact that you can go from 0 to 500 basis points in rate hikes, this an extreme inversion on the yield curve, no matter what part you're looking at. And, economies doing this or that, the housing market getting softer, the global conflict, and there's no recession. I mean, that gives you something different to worry about altogether.
There's two things that are
it hasn't happened before. Right?
There's two things that are totally different this time around. And people always say this time is different. Well, this time is really different. Number one, I keep on stressing the tightness of the labor market that we just not have had in literally a generation. The labor shortages, I think, will continue to put upward pressure on wages in Europe, in the US. Who knows what's going to happen in China? And that's just something we haven't dealt with. That's the how acute those labor market shortages and how much that's buoying consumers. Number two is the amount of money that was pumped into households. Literally, governments printing money and then injecting that directly into a household balance sheet. We've talked about a low savings rate. That's a red herring. It's not about that. It's not about the flow of savings, the stock of savings. That is still very, very, very high. And that acts as a buffer. And I think the third thing is a little bit of inflation is really, really useful. And it's just, a lot of inflation is bad. Maybe not enough inflation is also bad. But a little bit of inflation is great. It helps companies increase their margins, pass through cost increases. It helps countries deal with solvency issues. And I think that's those three things just we haven't dealt with. And that's changing sort of the math and how we assess normal indicators, whether it's low PMIs or inverted yield curve, or et cetera. I haven't really fully thought out the rest of it, but those three things are just wildly, wildly different than normal.
It is rather ironic, though, that, inflation was undershooting for over a decade and central banks were desperate to conjure up 2% inflation. And then, the cat got out of the bag and, here we are trying to beat it over the head.
You be careful what you wish for. Oh, and by the way, the answer to your question, the BOC currently holds 34.5% of total government bonds outstanding, which is just absolutely bananas, by the way.
That's almost on Japan's level. Granted, the bond market here is tiny, but
yeah. So it's,
I know Japan's data is more, but the Bank of Canada's number is coming down. It's not a function that their, QT is helping a little bit. It's just a function that Ottawa continues to borrow like a boatload of money all the time. That's
the other thing. So good
back
point.
To the comments that you made, Rich, a little bit was right. Most of it was wrong. And I love the shock value, especially watching Steve go, oh, here we go. So here we go. But again, you can't have a continual wage increases. So again, if you're running a company and you have X number of employees and you have to continually bump up their wages or salaries or benefits and stuff like that, you have to pass that on to consumers or whoever your end buyer is. If not, your margins start to shrink, and then pretty soon you're not making any money. Then you got to do layoffs and so forth. And that's the point that I'm making. We're at that nth degree now where it cannot get any better. So if people have the expectation that they'll continue to get pay hikes or pay wage increases, I don't know how companies are going to be able to do that. Because if they do, it means, inflation is going to continue to scream higher. So then the central banks, they go, oh, we made a mistake here. They start hiking again. And that's my point in that if we don't get a recession come here, that's what I mean by the system is broken and like something is wrong here. And there's nothing wrong. Things have just been delayed.
That's it. So your hearing has failed you again, Keith, because that was my point last week. And my point again now is not that we're not going to get the recession, is that I think it just will take a little bit longer than we might have expected, or people like us who are acutely like hyper aware of it. We expect it to happen in Q2. Well, maybe it's Q4. It doesn't mean we're necessarily wrong. It's that you have a bunch of stuff that's helping delaying otherwise what we would call the inevitable.
It's funny. I'm just looking at an economic survey here now on Bloomberg. Anyway, they're surveying economists, right? Not podcast host, co-host. Anyway, the number is 65% are fully expecting a recession here in 23. This is for the American economy. So, you can massage that for Canada.
I mean, the U.S. has though. It's pretty widely telegraphed too.
Well, the New York Federal Reserve has a recession probability indicator that's based on a yield curve model, basically, and it's at 47% as of yesterday. I don't know what it is today, but it's at 47%. So 50-50. I mean,
it still seems
like
low.
The odds of San Francisco winning the Super Bowl. It's less. It's more than that.
It's less than 47.
That's right. But why don't we move on, guys? There's loads of other stuff to talk about.
That's silence. I love it. I want to talk about the RBC CEO interview on Bloomberg, because some people were suggesting there was something going on with it and stuff like that. So first of all, for everyone, if you're the CEO of a major bank or any publicly listed company that's traded, and especially a bank, by the way, you can't talk truthiness on an interview. You have to be very vanilla, straight down the middle. You can't come out with you can't say anything new and stuff like that. Like there's actually rehearsed before you go on with your legal department and things. And at the same time, whoever you're doing the interview with, again, if you're at the bank CEO level, it is with the not just mainstream media, but the very, very big mainstream media. So in this case, it was BNN, Bloomberg. It's agreed beforehand what's going to be discussed and what will not be discussed. So, he came out and he said, we're expecting 25 basis points. And again, that's what the market was expecting. If he came out yesterday and said, we're expecting 50, the whole world went, oh, wait a second here. They must know something, because they have the biggest mortgage book in the country. Or if they said, something different. So he has to be unshocking. He has to be, bank boring CEO.
It was boring, all right.
Yeah, they're pretty good at it. At the same time, though, again, they have more access to information than everyone in the country. And it was, instead you talk more about, acquisition strategy, what they're hoping to achieve. He managed to bring the conversation to climate change and how as a bank they see it as being very important. Yeah, of course, right. And then on the other side of it, you had the the reporter, with that was interviewing him, and he's just laying up these softball questions. So it gets headline news coverage when it comes out on social media and everything. But you have to be completely shocked if something of substance is going to come out of that interview. And again, if we had him here on the Loonie Hour, we'd have some pretty good questions for him, and it'd be fun, right? You just want a frank conversation, and which sort of leads next into the Bank of Canada presser, because it got a bit salty there with two questions. Do you remember that, Steve, when you were watching?
Yeah, they were lobbing a few. I think I can't remember who it was. Was it Kevin Carmichael or something? I think he lobbed out the question with their balance sheet, because there's been a lot of publicity around the Bank of Canada like losing money over the last 6, 7, 8 months or something. Rich, you and I have chatted about this offline, but happy to chime in there. But kind of more or less irrelevant. Obviously, the media is playing it up. But I don't know if you want to quickly comment on that.
Sure. I love any time that people grill central bankers, so I won't hold it against that person. I can't remember who it was, but that's a red herring. The central bank is owned basically by the government, so it's like owing your wife $5 or Mrs. Icecap $10 or whatever. I mean, the reality is if the bank goes into, let's say, deficit, e.g., it loses money one year, then the central bank just tops it up, and vice versa. When central banks make money, which they have in the past, as you know, if yields come down, they'll make lots of money, and so right, because your yield goes down, your bond price goes up, and whatever, and so they remit those profits to the treasury. The legal ease about who exactly owns it or how many shares there are or whatever it is an irrelevance. The reality is it's two hands in the same person, and it's just I understood why the journalist asked the question, but in reality it's a total non-starter. It was a waste of time.
Which is interesting because that kind of leads into the next point, which is like, so this is kind of largely the whole theory of modern monetary theory, right? So the idea is that, well, the central bank is essentially an extension of the federal government, that basically the federal government can hypothetically run unlimited deficits, and the central bank can effectively monetize those debts. They can basically come in and purchase up those debts, and the only thing that restrains government spending is inflation. That's right. Modern monetary theory, and that obviously with one very sorry to interrupt you. One very important caveat: the way that in normal, what we have now, if you want to slow down inflation and slow the economy, as Keith has expressed many times, is you raise interest rates to basically to slow demand and induce a recession effectively. In modern monetary theory, you allow the government to raise taxes in order to slow down basically demand. But no one's ever going to do that if you're the government, because you're not going to punish your electorate and then go to the polls. And then effectively what you get is Argentina, where you just get lots of printing, no restraint on the budget side, and inflation goes to the moon. And this is why no one's talking about modern monetary theory anymore. Anyways, it's just I'm laughing because it's really funny. I still see some of these quote journalists in Canada still kind of talking about that and lobbying for it and calling for more government help to fight inflation and mail people checks. And yeah, it's tough to watch. It's really painful. I mean, hopefully this is why we put the show on. We get enough people to listen, watch, and share it, because there's a lot of very naive people out there.
There's lots of mistakes that central bankers have made, but the idea that they're in theory independent is a crucial point. They don't suffer the machinations of political will or the wind blowing one way or another. That's why I'm really not happy with Tiff, because he sort of moved away from that sort of sacred entente. But sorry, Keith, go ahead.
Yeah, a couple of points. One is just about the Bank of Canada. Another one's it's a cool conversation to have. When at the Bank of Canada presser, when that question was posed to the governor, his response immediately was, "Hey, this is not the platform for this conversation." Do you remember that, Steve? Like he was
he was like, "This is not about monetary policy." Basically,
he wasn't happy with that question, and he was immediately defensive about it. Because then all of a sudden, hey, that's been opened up. And then you had to start talking about it, and people were saying, well, "What do you mean you have losses now? Like, what does that mean?" and stuff like that. But then the other question before that, which is, I think there's one that ticked him off. I don't remember who the reporter was, but they effectively said, you seem very confident that this is now the right policy move, yet 2 or 3 years ago, you were also very confident when you told everyone their rates are going to stay low forever. And that was the wrong policy. He really went at him with which was an outstanding question. That's the kind of question, and it should be a conversation, right? And he did not like that question. And then he got the one about the balance sheet and losses. But I think his fuse was already lit by this point. But that's what happened. So I can tell you, I'm pretty confident that those two reporters got a, sternly worded email from someone afterwards about what was asked.
That's a shame. I hope not.
No gift basket next Christmas for Kevin Carmichael.
You're not allowed to ask questions like that. Like, there are numerous examples of reporters that has asked edgy questions to the central bank. Most notably, a few years back, what's the guy's name? Pedro da Costa, I think his name is. I think he was
That
at Wall
sounds
Street
familiar.
Journal. Yeah, he asked the Fed I think it was the Fed appointed question, and he basically had to go radio silent after he was no longer invited. He didn't have access anymore, and it basically stopped his career like in its tracks.
Hey, do you remember Andrew Bell on BNM Bloomberg? He's a beauty. So he was interviewing, it was Pelosi at the time, and he was like, "Aren't you the candy man? Like the guy that's been feeding everyone these low interest rates, and you're basically responsible for creating the high levels of debt that you've flagged as an inherent financial risk." I don't know. I thought it was hilarious.
Yeah, what was the response with that?
I mean, I think Pelosi is like way different than Macklin, right? He kind of like chuckled a bit and was like, "Well, yeah, I guess we are definitely partially responsible." Right. I mean, you kept rates at zero for 10 years. Of course, people took on a lot of leverage. Right. So, yeah, Pelot's the candy man.
I mean, of course they're responsible. It's ridiculous. I mean, anybody who would argue that is not paying attention. I mean, I understand his point about the MMT thing. I think he's right. People don't understand how central banks work as far as the remittances, the profits and losses. I think that's bullshit. The other question, Keith, that's an amazing one. I'm so happy that he asked that. It's like, you were wrong about transitory inflation and a litany of other things. What makes you so sure about you being right this time? I mean, can you tell us how he responded to that question, or did he just move on?
It's like word salad. That's
okay, great.
Yeah.
That's what I was expecting.
And in his defense, he's not going to say, "You know what? You're right. We screwed things up." And we're just hoping we didn't screw it up again this time.
I mean, I'd have more respect for the guy. I mean, that's why I really like Carolyn Rogers. I know she's the deputy governor, but I've watched a couple of speeches of hers, and at least she's like not outright apologetic, but I think she's much more. I mean, she's in her speeches, and the 3 or 4 of them that I've watched and read or what have you, it's clear from her that they know they made a mistake. And it's funny to me that Tiff is like unwilling to make that call. And I get, maybe that's the difference between the deputy governor and the governor, and maybe those are their roles. And internally, perhaps that they discussed that beforehand. But it is interesting to see the difference in Carolyn Rogers' explanation and Tiff.
She is really good. Rich, you know who the most popular player is on the football team?
The wide receiver. I don't know.
Quarterback.
The backup quarterback.
Oh, okay. Why?
Because you're never in the game. You're just there on the side. You can do some things, drink some Gatorade,
hold the clipboard.
I think once you become, my point though with Rogers, if she was the head, you're going to see a different different tune.
But she's much more articulate. She's much more articulate. She's just she's better at expressing views and speaking in a way that
what a great Loonie Hour conversation. Your favorite like second, third tier central banker for like a seventh tier central bank around the world.
Yeah.
Who's your favorite backbencher for the Brazilian central bank? Guys, I have something more important though to talk about, and this is something I think hopefully you'll gather steam. See, the challenge with our culture today, not only in Canada but everywhere else, if you think about this, so people grow up without having a clue about finances. Like, they don't know it, and a lot of people, it doesn't matter if you're in the government side or in the private sector. Why isn't this being taught in school? This should be taught very soon as you start in primary or kindergarten. You learn a little bit every single year just about budgeting and money coming in and stuff like that. And it's shocking. Kids graduate from high school, they don't have a clue what finances. No clue. Go to university and, still no clue. And then all of a sudden, they're allowed to vote. Maybe some votes aren't worth as much as others. But my point, though, is that
Ron DeSantis has introduced this bill, by the way, recently, where he's introducing economics and basic like balancing your checkbook and understanding interest rates and mortgage rates and that kind of stuff into the.
I think very basic
curriculum.
Household finances should be taught at all school levels, and it is.
I think it's by design, though.
No, come on.
Well, no, I don't know about that. I think then it comes down to, okay, who's going to teach it? Right. Because it's not, you have to face it. If you're involved in that kind of a world, you tend to gravitate towards, the private sector, the banks and stuff like that. But there are ways to do it, right? It doesn't have to be a year-long course. But again, my point is that like we teach our kids about money all the time, right? And but I know other families, they don't do it. Like there's no discussion about it and kids don't have a clue. But it is something that's missing from our education system. And it has to be a part of it. Like when you go to university, you have these like core courses you have to do, and it's, it's economics 101. It should be there. Now, mind you, it shouldn't be taught by a communist either. It should be taught by someone.
I was waiting for you to say. I'm surprised it took you that long to get there.
Yeah, I know. I some of my friends, I call them commies, and they don't know what I mean. But maybe that's what it is. But that's just a statement.
I've always said this before, though, which is like, just go to your next family dinner or next time you meet up with your buddies in the hockey team or whatever. Just ask them, hey, do you know who Tiff Macklem is? I can guarantee you, like, my guess is 90% of Canadians don't know who he is.
But wait, there's another angle to that. If he's doing his job right, you shouldn't know who he is. Let's just say, what does the Bank of Canada do? Okay, fair enough. That's a better question, perhaps.
I think the vast majority of Canadians would struggle to answer that question, which is a very interesting, because ultimately these people are he's responsible for setting the price of money. It's that simple.
Yeah, it's true.
And
so my son had to write a paper about European history and stuff like that recently. And the topic was broad, whatever he wanted to choose. Guess what he wrote about, Rich?
The euro?
He did.
Well done.
The euro and the ECB and everything. And I got an A on that paper. I did a good job.
Well, maybe we should talk. Did you write it?
I mean, no. I'm always like,
so funny.
I'm always out there explaining to people, like, when they're going to make like, house purchases. I mean, in Vancouver, $1 million house purchase is very common. I mean, given where prices are at. So, people are about to make $1 million investment, and just explaining, variable rate mortgages versus fixed rates, and how, because you know what I mean? Like, people are like, well, the Bank of Canada's stopped raising rates, I hear. So that's a good, then they have to explain, well, like fixed rates have already started to move because it's already stopped the bomb. Like, people don't, it's interesting, right? I mean, again, you're about to make $1 million investment, and people don't really know the mechanics of, mortgage rates and how they function and product type and all that other stuff. I mean, that's partly our job, obviously, to explain it to people, but it's just interesting that people just kind of plow in and there's just not a real strong grasp of financial literacy in the country.
Well, I mean, Keith, can we segue into Europe for a second? Because Keith mentioned euro, and he's convinced that the euro is gonna not last very long. I actually think it's gonna. I think what we've seen actually is the fact that Germany's has such a bad couple of years actually makes the euro stronger. But one thing I think that's maybe a conversation for a different day. What I think is important to note is that, as we've seen with the risk on in China and Asian markets, we've seen a lot of the European data has actually come in really, really strong the last few weeks. So we've got ZEW, which is a German institute similar to the PMI and ISM, that came out strong. We've got Centix, which is another sort of investor sentiment that's rebounded. The current account balance, which was negative for the first time, I think, in something like 30 or 40 years for Germany, is now positive. Same with the euro area. It's bounced hard. And I think that's so, maybe rumors of the euro's death were greatly exaggerated, Keith, or are you still absolutely convinced it's over?
Don't get them going. Don't get them going.
I think you should run out and put all your money in European
I wouldn't.
banks.
Come on,
You'll
that's
make
bad
a
risk
killing.
management, Keith. That's bad risk management.
And I don't mean in the equity markets. Just put them in there in the basement of the banks, and
It's bad risk
you
management.
know what? You know, everything is having a bounce here right now, but absolutely nothing has changed for the long-term outlook for the Eurozone. And the same with Japan as well. Like these guys, they're backed into this corner, and it's impossible. So the only way that would make life a whole lot better for the Eurozone would be if they consolidated all the federal debt.
They're going to eventually. That's eventually what's going to happen.
Yeah, I would not be. Don't hold your breath on that.
Well, do you know what happened in South America? Do you know what's happening in South America? They're going down. Do you know? Have you heard?
No, what's happening?
Brazil and Argentina want to create their own currency union.
I saw something like that. What is
Which
the
is
story behind
fascinating.
that?
So basically, they want to create I don't know. We'll call it the Pele, which is it's a currency that it's basically they want to create a currency block, and the currency block will be Argentina and Brazil. And I mean, to me, the writing would be on the wall. They would include, Uruguay or whatever, all the neighbors or whatever. And I think what they wanted to do is make it basically commodity-backed alternative to the euro or the dollar. So despite all the euro's misgivings, it's one of the most important reserve currencies in the world. The US is about 55% of global foreign currency reserves are US dollar. Then it's about 14 or so for, I want to say euro. And then next is the yen. The renminbi is very, very small, and Canada is really small, and there's a couple other whatevers. There's been some pushback from emerging markets, whether it's Saudi Arabia, China, certainly Iran, and a bunch of other emerging market countries that want to move away from the US dollar as the main trading currency for goods and services, but mostly goods, and certainly commodities, and especially oil. And Brazil and Argentina have been floating this idea to create this new currency, which I'm now coining the Pele, and basically have it a commodity, more or less a commodity-backed currency union between Argentina, which, by the way, makes Europe look like makes Europe look positively sane with all of its horrific economic policy over the last 100 years, and they would be joined up with Brazil, and the two of them would have their own currency block. And to rival whatever the euro, etc. I think it's a really fascinating story, something to watch going forward. I think it's totally bogus, of course, it'll never work, but it is interesting.
Maybe we should put some of our Loonie Hour reserves in there.
No.
Do you like the name though, Keith? That's a good name, no?
Yeah, I do like the name. I think it's really good.
So Keith, just to summarize here, we're wrapping up the show, but just to summarize, because I think there's a lot of confusion in markets right now. There's confusion around the housing market in Canada, what's happening. There's confusion in equity markets. We were told this big recession's coming. Your view is still, this is a bear market rally. And, again, I think it's important to sort of put into context, time horizons as well. I mean, I think you could make an argument that you could trade around here. But I think if if you have a sort of a more longer term outlook, you are still of the view that there's more downside coming, and that this is sort of a bounce.
Yeah, it's still our. We think the probability of equity seeing lower levels from here are a lot higher than what the market is currently saying. So we continue to move along this path, and things can change, absolutely. But again, things are set up to come off a little bit because at the next, remember, we're just getting companies now are reporting and they're starting to warn. So then maybe, we got the Fed next week, and, they're going to, some people think they only have 25 basis points left in them. I think they have at least 50. So, we're going to continue to go back to this story where we're headed. But yeah, that's our response to it. But you think about though, over the last, we added long bonds to our portfolio about 5 months ago now, 4, 6, I don't know what it is. And it was on the expectation that the recession story would start coming into play, and that's happening, right? Like that. If you've been in the 10-year over the last, again, I'm going to say 3 to 5 months, I think You've probably made 5 to 8% on that trade, depending on your entry point, which really goes. So I bring that up because that's the path back then that we thought we would go on. And as of today, that continues to be the path, that we're going on. So when you're managing portfolios, when you get a whole bunch of different markets you're looking all the time, and you have your overriding expected path where we're going to go economically in financial markets, reacting and stuff like that with it. And all I'm saying is that hasn't changed for us as of right now. And so again, like the big one now will be the Fed coming out next week, and then we'll make adjustments from there.
Interesting. Yeah. Well, I think that's a good way to wrap it up. As always, we appreciate your guys' support here on the Loonie Hour. All we ask is that you leave us a 5-star review on Apple Podcasts there or Spotify. Continue to boost us up in the algos, and we'll continue to grow the Loonie Hour community. Share us with one friend or family member, and we'll see you next week.